Hello, and welcome to this session on Student Loan Management and the Public Service Loan Forgiveness Program. My name is Nathan Lohr, and I'm an Assistant Director in the IUPUI Office of Student Financial Services. I want to thank you for joining us as we learn more about federal student loan repayment and loan forgiveness opportunities. I'll be sharing with you some tips that you can use to successfully manage your student loan repayment, information about forgiveness opportunities, including public service loan forgiveness, and some helpful resources that you can explore for more information later. To begin, let's review what happens between the time you leave school and the time your first student loan payment is due. First, the university updates your enrollment status. We officially list you as a graduate of the school. Next, your grace period begins. The grace period is a 6-month time period between when you leave school and when your first payment on your loans is due. Your student loan servicer will be contacting you throughout your grace period, letting you know when your first payment is due and what the amount of that payment will be. At the end of 6 months, your grace period ends and you make your first payment on your student loans. A lot can happen during your 6-month grace period. So, let's take a look at some of the steps you can work on to ensure successful repayment of your federal student loans. First, you want to identify your student loan servicer and set up an online account. Your student loan servicer is an organization contracted by the Department of Education to assist you with your federal student loan repayment. In many cases, your servicer has been contacting you since you first started to receive student loans. Your servicer will be contacting you even more during your grace period as you prepare to enter repayment. Servicers will notify you of upcoming payment due dates and amounts. And in most cases, all of your federal student loans will be serviced by the same student loan servicer. This is not the case for private loans, which are typically serviced by the company that issued them. There are 11 different organizations that work as federal student loan servicers for the government. These include Great Lakes, Nelnet, Fed Loan Servicing, and Navient, the new name for Sallie Mae. If you're uncertain who you'll be working with as your federal student loan servicer, the easiest way to determine the name and contact information for that organization is to log into the National Student Loan Data System. NSLDS is an online database that houses all of your federal student loan borrowing history. You can access NSLDS at nsLDS.ed.gov. Logging into your financial aid review will display a list of all of your federal student loans. Click on the number next to any loan for more information. Here you'll be able to see the name of your student loan servicer, as well as contact information, including website and telephone number. Once you've determined your federal student loan servicer, you'll next want to create an online account. Creating an online account for your student loans is very similar to creating an online account for a bank account or credit card. Your online account will give you a number of benefits. For example, it gives you real-time access to your student loan status, including the remaining balance due on your loan and any interest that has accrued since your last payment was made. Your online account also allows you to confirm or update your contact information. This is valuable because your student loan servicer will be sending you important documentation on a regular basis. This documentation includes statements at the end of each year about the amount of interest that you paid on your loans. This interest may be deductible on your tax return. Your online account also gives you information about how to manage your loans and different options for repayment plans available to you. Your online account will also allow you to make payments towards your federal student loans or authorize other individuals to make payments on your behalf. You can also use your online account to make changes to your federal student loan repayment plan. Once you've created an online account with your federal student loan servicer, the next step to consider is making an interest payment on your loans before entering repayment. Let's take a few moments to talk about student loan interest. Interest on federal student loans accrues daily. On unsubsidized loans, interest that you must repay begins to accrue at the time of disbursement. For subsidized loans, the government pays the interest on your loan while you're in school. Interest that you must repay begins to accrue at the time of repayment. To determine how much interest has accumulated on your loans, you can request a total from your servicer or review the total online through your student loan account. The amount of interest that accrues is based on the amount that you borrowed from the federal government. At the time you enter repayment, Any interest that hasn't been paid is capitalized. This means that the accrued interest is added to the original amount that you borrowed. This new total becomes the amount that interest is assessed on moving forward. Let's take a look at a quick example. Let's say you borrow $5,000 at an interest rate of 6.21%. If you enter repayment 2 years later, $642 of interest will have accumulated. Your options are to pay the interest or to not pay the interest. If you pay the interest, you enter repayment with a principal balance of $5,000. This means that over the course of a standard 10-year repayment term, you'll be making monthly payments of $56. If you don't pay the interest before entering repayment, the interest is added to the original amount that you borrowed. This creates a new principal balance of $5,642 at the time of repayment. The result is a monthly payment amount of $63. The difference between the two isn't great, but imagine the difference if you borrowed more than $5,000 or if your interest rate were higher. In any circumstance, the amount that you pay overall on the loan by not paying your interest before entering repayment is greater than if you paid the interest before entering repayment. Making even a small payment towards your interest before entering repayment can be incredibly helpful. As you prepare to enter repayment, it's important to know what your options are for repaying your student loans. Let's take a look at the options for federal student loan repayment. Repayment plans include standard repayment, graduated repayment, extended repayment, pay-as-you-earn, income-based repayment, income contingent repayment, and income-sensitive repayment. Standard, graduated, and extended repayment are borrowing-based. In other words, the amount that you pay each month under these repayment plans is based on the overall amount that you borrowed. Pay-as-you-earn, income-based repayment, income contingent repayment, and income-sensitive repayment are borrower-based. These repayment plans are based on your amount of income and number of household members. A quick note before we look at the individual repayment plans. There are two different programs under which students may have borrowed loans from the federal government: direct lending and the Federal Family Education Loan Program. Under the direct loan program, a student borrows money directly from the federal government. Examples of direct loans include direct subsidized, direct unsubsidized, direct plus, and direct consolidation loans. Under the Federal Family Education Loan, or FFEL program, individuals borrow from private lenders, and those loans are guaranteed by the federal government. Examples of FFEL program loans include subsidized federal Stafford loans, unsubsidized federal Stafford loans, FFEL Plus loans, and FFEL consolidation loans. Some repayment plans are only available to loans borrowed under certain programs. To determine the type of your federal student loans, you can access your financial aid review through NSLDS. Any loan borrowed under the Federal Direct Loan Program will be clearly labeled as a direct loan. Also, as of July 1st, 2010, all new federal student loans are direct loans. Any FFEL program loan will simply be listed as the name of the loan. For example, Stafford Unsubsidized. If you're uncertain about your types of loans, feel free to contact your federal student loan servicer for more information. Let's begin our review of federal student loan repayment plans by looking at the standard repayment plan. Under standard repayment, a borrower pays a fixed amount each month for up to 10 years. At the end of that 10-year repayment term, the loan balance is paid off in full. All loans, both direct and FFEL program loans, are eligible. Please note that some consolidated loans have a standard repayment term of greater than 10 years, in some cases as long as 20 to 25 years. Again, with standard repayment, you'll pay the same amount every month for 10 years and your loan will be paid off. Repaying your loans under standard repayment will result in the lowest amount of interest being paid on the loan. Also, standard repayment often results in the borrower being in repayment for the shortest period of time possible. However, standard repayment typically results in a monthly repayment amount that is higher than monthly payments under other repayment plans. An option for monthly payments lower than those under standard repayment is the graduated repayment plan. Under graduated repayment, monthly payments start out low and increase every 2 years. Borrowers are in repayment for up to 10 years, and all direct and FFEL program loans are eligible. Again, please note that some consolidated loans have a graduated repayment plan with a repayment term longer than 10 years. For students with larger loan balances, extended repayment may be an option. Under extended repayment, the borrower repays the loan for up to 25 years. Monthly payment amounts can either be fixed, where the borrower is paying the same amount every month for 25 years, or graduated, where monthly payments start out low and increase every few years. All direct and FFEL program loans are eligible for extended repayment as long as the borrower has at least $30,000 in outstanding loans from either the FFEL program or the direct program. Please note that this is not a combined total. A borrower must have at least $30,000 in FFEL program loans or at least $30,000 in direct loans in order to qualify. A benefit of both extended and graduated repayment is that the monthly payment amounts are typically lower at the beginning of repayment than they would be under standard repayment. It can be more affordable for a borrower to pay under these plans than under standard repayment. However, extended and graduated repayment often result in the borrower paying more interest over the life of the loan. And in some cases, the monthly payments under these repayment plans may actually be higher than the monthly repayment under standard repayment. Now let's take a look at some of the income-driven repayment plans. As a reminder, under income-driven repayment plans, the monthly repayment amount is based not on how much you've borrowed, but on your income and family size. The first plan we'll look at is Pay As You Earn. Under Pay As You Earn, the monthly amount is calculated as 10% of your discretionary income. The Pay As You Earn repayment plan has a repayment term of up to 20 years. Only direct loans are eligible for Pay As You Earn, and the borrower must demonstrate a partial financial hardship in order to be eligible. What this means is simply that the monthly amount that you would pay under Pay As You Earn is less than the monthly amount that you would pay under your standard repayment plan. At the end of the repayment term, the remaining balance of your loan, both principal and interest, is eligible for forgiveness. However, the remaining balance that is forgiven is considered taxable income and must be reported on the following year's tax return. Income-based repayment is very similar to Pay As You Earn. However, there were a few key differences. First, the repayment term is extended from 20 years to 25 years. Also, the monthly amount of your payment is set at 15% of your discretionary income instead of 10%. Also, under income-based repayment, FFEL program loans are eligible in addition to direct loans. Just as with Pay As You Earn, the borrower must demonstrate partial financial hardship in order to be eligible. And at the end of the repayment term, in this case 25 years, any remaining balance of principal and interest is forgiven. However, that forgiven amount must be reported on your next year's tax return as taxable income. The final primary income-driven repayment plan that we'll look at is income contingent repayment. A few things to note here. Under income contingent repayment, the monthly amount is typically set at 20% of your monthly discretionary income. Repayment occurs for up to 25 years, and at the end of the 25-year repayment term, any remaining balance is forgiven. However, again, any balance that is forgiven is required to be reported as taxable income on your next year's tax return. Under income contingent repayment, all direct loans are eligible. One final income-driven repayment plan to be aware of is income-sensitive repayment. Income-sensitive repayment is only available to FFEL program loans. Please note that less than 0.1% of all borrowers are using income-sensitive repayment to repay their loans, and in many cases, another repayment plan will be more beneficial for you. Income-driven repayment plans have a number of benefits. For example, they often result in a lower monthly payment amount, especially at the time when you would enter repayment. Because income-driven repayment plans are based on your income, you'll never be required to make a monthly payment that is more than you can afford. Also, income-driven repayment plans can allow for some of the loan balance to be forgiven under certain forgiveness programs. We'll take a look at these programs in greater detail later in the session. However, income-driven repayment plans do have some downsides. For example, they can result in you paying more interest over the life of the loan. Also, income-driven repayment plans can allow for negative amortization. This occurs when the amount that you're paying each month is less than the amount of interest that's accruing on your loan. In some cases, your loan balance could actually be increasing every month even though you're making payments. Also, because income-driven repayment plans are based on your income, you must reapply each and every year in order to maintain your eligibility. Finally, as we discussed, under the income-driven repayment plans, the remaining balance that is left at the end of your loan term can be forgiven. However, that is considered taxable income on your next year's federal tax return. Let's take a look at an example that will illustrate the difference between these repayment plans. In this example, the student has $40,000 in loans. The loans have an interest rate of 6.21%. The student is single and has an annual income of $30,000. The top 4 lines represent the borrowing-based repayment plans. Again, the monthly amounts under these plans are based on how much debt you have as a borrower. The bottom 3 lines are based on the income-driven repayment plans. As a reminder, the monthly amounts under these repayment plans are based on your income and household size. This chart illustrates the starting monthly repayment amount and the final monthly repayment amount, the length of the repayment term, total amount of interest paid on the loan, total amount paid on the loan under each repayment plan, and the projected loan forgiveness that is available at the end of the repayment term. To see a chart based on your personal situation, use the Department of Education's repayment estimator. Logging in will allow the Department of Education to access your personal borrowing history through the National Student Loan Data System. You'll answer a few questions about your income, household size, and state of residence. And based on this information, you'll receive an estimate customized to you. You'll also be able to see which repayment plans you qualify for. In this example, the student didn't qualify for pay-as-you-earn or income contingent repayment, so no amounts were listed under those repayment plans. Again, this chart will give you an estimate of your monthly payments both at the beginning and end of repayment, the length of the repayment term, the overall interest paid on the loan, and the total amount paid on the loan through repayment. Once you know your repayment plan and monthly payment options, it's important to establish a spending plan that includes your federal student loans. This is because your income and expenses can change very dramatically after graduation. Student loans join rent, cell phone, food, car payments, cable, and other expenses as a regular monthly bill that you'll owe. It's important to know before you owe how your payment will fit in with your other costs. I encourage students to start paying their loan before the end of their grace period. You're not required to make a payment on your loan until 6 months after you leave school. However, if you have a spending plan in place and know the amount of your monthly repayment for your student loans, make a payment before the end of your grace period. As we saw earlier, any payment that you make before entering repayment will reduce the amount of your interest. Reducing your interest reduces the amount of your principal balance that will be in place when you enter repayment. You'll help yourself out in the long run. Also, you'll get into practice of making that monthly payment towards your student loans before you're even required to. Also, creating a spending plan can help you use your financial goals to make good decisions about what type of repayment plan to use. For example, if it's important for you to get out of debt as quickly as possible, it may not be a good idea to select a repayment plan with a 25-year repayment term. There are apps and online tools that can help you track and plan your overall spending, and your servicer has valuable information on their websites to help you create your plan. Great Lakes, for example, has a section of their website that allows you to budget based on the amount that you owe and your monthly repayment plan options. Fed Loan Servicing has a section of their website called You Can Deal With It, a great tool to use to help you plan and implement a budget that includes your federal student loans. A few other important payment notes. Amounts paid above and beyond the required monthly payment can reduce your outstanding principal balance. Just make sure to let your servicer know that you want your extra payments to go for this purpose. Also, there's no prepayment penalty on federal student loans. You can pay off any or all of your outstanding loan balance at any time with no penalty. It's important to make payments towards your federal student loans because there are very negative consequences that can result if you don't. For example, your student loan account can become delinquent. This can result in added fees, collection costs, and the accrual of more interest on your federal loans. Accounts that are delinquent more than 270 days can enter a default status. Among the serious consequences of this are that federal and state income tax refunds can be withheld, you can find your wages being garnished to repay a portion of your student loans, and you lose eligibility for future federal student aid. If you find yourself in a situation where you can't pay your student loans, it's important to take action. There are forbearance and deferment opportunities that can temporarily postpone payment for borrowers experiencing a financial hardship. You can also explore income-driven repayment plans, which may lower your monthly payment and make repayment more affordable. If you find yourself experiencing a financial hardship, contact your loan servicer for more information about these options. It's important to take action if you find yourself experiencing financial difficulty, because your student loans aren't going to go away. Loans can only be discharged under very rare circumstances, such as death or total or permanent disability. Even filing for bankruptcy, in most cases, won't eliminate your federal student loan debt. Once you've reviewed your repayment plan options and established a spending plan that includes your federal student loans, the next step is to officially select your repayment plan. A few thoughts as you consider which repayment plan is best for you. First, sooner is better. Let's take another look at the example we saw earlier, different repayment options for a student with $40,000 in loan debt. If you review the repayment period column, you'll see that the standard and graduated repayment plans have repayment terms that are the shortest, in this case 120 months. Now look at the total amount paid column. You'll notice that standard repayment and graduated repayment offer total repayment amounts that are less than nearly all of the other repayment options. The sooner you repay your loan, the less you'll pay. Also, the more you pay, the less you pay. Let's look at this example again. You'll notice that the standard repayment plan has the highest monthly payment amount of all the repayment plans. However, it results in you paying the least amount overall of any of the repayment plans. The more you pay, the less you pay is also true when it comes to your required monthly payment amount. Consider paying more than is required. Let's look at that example in closer detail. Under standard repayment, you're required to make a monthly payment of $448.31. Doing so pays your loan off in 120 months. However, paying an extra $10 a month allows you to pay the loan off 3 months sooner, and it allows you to save over $440 in interest. If you increase that extra payment to $25 a month, now you'll pay the loan off 8 months early, and you'll save over $1,000 in interest. Double that to $50 extra a month. Now you're paying your loan off over a year early, and you're saving yourself almost $2,000. One last example. If you pay an extra $100 a month above your required payment, you'll pay your loan off over 2 years early, and you'll save over $3,440. The more you pay each month, the less you'll pay overall. One final consideration. Cheaper isn't always better. Going back to our example, you'll see that the monthly payment amount under the extended fixed plan is only $263 a month. This is nearly $200 a month less than the monthly amount under the standard repayment plan. However, making payments under the extended fixed repayment plan results in you paying over $25,000 more on the loan than making payments under the standard repayment plan. In addition, you're in repayment an extra 15 years. Just because the monthly payment amount is less doesn't mean that it's the best option. Once you've decided which repayment plan you'd like to use, there are several options for making that choice official. If you do nothing, your federal student loans will enter repayment under the standard repayment plan. This is the default repayment plan for all federal borrowers. To select a different repayment plan, you can indicate your preference when completing your exit counseling session through the Department of Education. You can contact your federal student loan servicer. Or, if you're interested in an income-driven repayment plan, you can complete an application and a request for pay-as-you-earn, income-based repayment, and income-contingent repayment at www.studentloans.gov. The last step in preparing for successful repayment is to sign up for automatic debit payments of your student loans. Under automatic debits, your loan payments are automatically deducted from your bank account each month. So, why enroll? First, auto debit ensures that your payments are made on time. Because the payments are automatically deducted from your bank account, you'll never forget to send in your required payment. Also, Most borrowers qualify for a 0.25% interest rate reduction for on-time payments made through automatic debit. Making your payments through automatic debit will save you interest on your loans. Finally, you have to make the payments anyway. Why not make them in a way that will ensure that they're made on time and gives you a financial benefit? Now that we've talked about ways to successfully manage your student loan repayment, let's talk about opportunities to have a portion of your loan balance forgiven. As we saw earlier, if you reach the end of your repayment term under the pay-as-you-earn, income-based repayment, and income contingent repayment plans and still have principal and interest outstanding on your loan, that remaining balance can be forgiven. However, as a reminder, that remaining balance is considered taxable income on your next tax return. There's also a forgiveness program for teachers. The Teacher Loan Forgiveness Program allows borrowers who teach full-time for 5 consecutive academic years in certain elementary and secondary schools to have a portion of their federal student loans forgiven. Other forgiveness opportunities exist through government agencies and private organizations. In many cases, you are eligible to have a portion of your student loan balance repaid in exchange for your service. Examples include benefits through the AmeriCorps and Peace Corps and the National Health Service Corps Loan Repayment Program, state programs including the Indiana Loan Repayment Assistance Program for mental health and addiction professionals, and programs available through individual employers. In some cases, you may find that your employer will repay a portion of your student loan in exchange for your commitment to serve that employer for a certain number of years. Also, forgiveness is available from the federal government through the Public Service Loan Forgiveness Program. Public Service Loan Forgiveness is offered by the Department of Education and allows eligible borrowers to cancel the remaining balance of their direct loans after serving full-time at a public service organization for at least 10 years while making 120 qualifying monthly payments. So, to qualify to have a portion of your loans forgiven under Public Service Loan Forgiveness, you must work for a qualifying public service organization, maintain a full-time employment status, have eligible federal student loans, make 120 qualifying payments, and make those payments under an eligible repayment plan. Let's take a look at each component of Public Service Loan Forgiveness individually. First, you must work for a qualifying organization. Qualifying employers include federal, state, local, or tribal government organizations, agencies, and entities. That includes most public schools. For example, IUPUI is a qualifying employer under Public Service Loan Forgiveness. You could also work for a public child or family service agency, any nonprofit organization that is recognized under Section 501c3 by the IRS. You could work for a tribal college or university, the AmeriCorps or Peace Corps. You could also work for a private nonprofit organization, as long as that organization provides at least one of the following public services. These services include public safety, law enforcement, public education, school library services, public service for individuals with disabilities and the elderly. As long as that private nonprofit organization provides one of these services, employment at that organization qualifies. A few important notes. The specific job that you perform doesn't matter. It doesn't matter what you do, it just matters where you work. You could work as a president, vice president, supervisor, case manager, accountant, janitor. It doesn't matter what you do, it just matters that the place that you work for is a qualifying employer under Public Service Loan Forgiveness. An important caveat is that this does not include staff of for-profit contractors who just happen to be performing a job at a public service organization. So, to confirm that your employer qualifies, you can touch base with your Human Resources Department, or you can access any of these 3 websites for a list of government agencies that qualify, tribal colleges and universities that qualify, and 501c3 and private nonprofit organizations that meet the criteria. So, you first have to be working for a qualifying organization. You also have to be working for that organization full-time. For Public Service Loan Forgiveness, full-time employment is the number of hours that your employer considers to be full-time, or an annual average of at least 30 hours per week. Under Public Service Loan Forgiveness, if you have more than one employer, as long as both employers qualify as public service organizations, and as long as you're working an average of at least 30 hours per week combined through those multiple employers, then you meet the employment criteria for public service loan forgiveness. A few important notes. First, employer-provided leave time counts as hours worked when determining your full-time status. So, if you take a leave from work under FMLA, you're still considered to be full-time with your employer. Also, employment does not have to be for the same employer during repayment. You can work multiple jobs for multiple different employers. As long as each organization that you work for meets the criteria as a qualifying public service organization, then your overall employment will count. In order to qualify for public service loan forgiveness, you also have to have qualifying loans. For public service loan forgiveness, only federal direct loans are eligible. As we saw earlier in the session, there are two different programs under which you may have borrowed loans from the federal government, the Direct Loan Program and the FEL program. Under public service loan forgiveness, FEL program loans are not eligible for forgiveness. The only way that a FEL program loan could be considered for public service loan forgiveness is if that FEL program loan was consolidated into a new federal direct consolidation loan. So let's take a few moments and talk about loan consolidation. Loan consolidation is the process of combining multiple federal education loans into one new federal direct consolidated loan. The amount of your consolidated loan will be the total of the outstanding principal and interest of the loans that were consolidated. The interest rate of the consolidated loan is the weighted average of the interest rates of the loans being consolidated, rounded up to the nearest eighth of a percent. Only loans taken out in the borrower's name can be consolidated. So, if a parent borrowed money on your behalf to help you attend school, you can't consolidate that parent loan under your name. Again, loan consolidation takes several individual loans and combines them into one new federal direct consolidated loan. All direct and FEL program loans are eligible to be consolidated, but at least one of the loans must be in a grace period or repayment. Repayment on consolidated loans begins 60 days or sooner after the consolidated loan is disbursed. So, if you consolidate a loan that is currently in a grace period, you forfeit the remainder of your grace period, and repayment on your new consolidated loan begins within 60 days. Loan consolidation can have several benefits. For example, it can make monthly repayment more affordable. By extending the amount of time you are in repayment, consolidation can result in a lower required monthly payment. Consolidation can also roll several loan payments into one loan payment, making repayment easier to manage. If you are currently making multiple payments to multiple servicers each month, consolidation can offer you the ability to make only one payment to only one organization. Consolidation can also allow FEL program loans to become direct loans, making them eligible for public service loan forgiveness. However, consolidation does have some drawbacks. Because it extends the amount of time you are in repayment, consolidation can result in you paying more over the life of the loan. Consolidation can also result in higher interest rates being assessed on your loans. Finally, consolidation may not be necessary. Even if you have multiple federal loans, in many cases, the federal government will assign all of those loans to the same servicer. So, even though you have multiple loans, you'll only be making one payment each month to one organization. Consolidation wouldn't be necessary to make this happen. If you do decide to consolidate, you can complete an application online at studentloans.gov. Let's get back to our discussion about public service loan forgiveness. Under public service loan forgiveness, you must make 120 qualifying payments. A qualifying payment must have been made after October 1st, 2007, must have been on time, must have been made each month, satisfying in full the installment amount due for that month, so partial payments wouldn't count, must be a required payment. So, payments made when the loan is in a grace period, deferment, forbearance, or default status do not count. In order for your payment to count, it must have been required. The payments don't need to be made consecutively. If you make 4 years worth of payments and then take a year or two off of work, when you return to work for a qualifying employer, you start where you left off with your payments. You don't forfeit any payments that you made before. They must have been made while meeting employment requirements. So, you have to make the payments while working full-time for a qualifying organization. And the qualifying payments must have been made under an eligible repayment plan. Eligible repayment plans for public service loan forgiveness include pay-as-you-earn, income-based repayment, income contingent repayment, standard repayment with a 10-year repayment term, and any other direct loan program repayment plan where the payments you're making each month are equal to or greater than the monthly payment you would make under the standard 10-year repayment term. All of these plans are eligible for public service loan forgiveness. However, not all are beneficial. For example, if you make 120 payments under the standard repayment plan, you'll have paid your loan balance off in full. There will be nothing left to forgive. So we encourage students who are interested in pursuing public service loan forgiveness to make payments under the pay-as-you-earn, income-based, or income contingent repayment plans. Doing so will maximize the amount of your loan principal and interest that is eligible for forgiveness after 120 payments. Let's take a look at an example provided by Fed Loan Servicing. In this example, the student has $31,000 in debt, an income of $25,000, and a family size of 1. As you can see, if a student makes 120 payments under the standard repayment plan, the student will have paid the loan off in full. There's nothing left to forgive. However, under the income-driven repayment plans, pay-as-you-earn, income-based repayment, and income contingent repayment, at the end of 120 payments, there is a portion of the principal and interest still left to be forgiven. The amount forgiven varies depending on the repayment plan that the student used. One very important note about public service loan forgiveness. Any principal and interest forgiven under the Public Service Loan Forgiveness Program is not considered taxable income on your next year's return. Again, forgiveness under Public Service Loan Forgiveness is not considered taxable income on your next year's return. To recap, to qualify to request to have the remaining portion of your loans forgiven under Public Service Loan Forgiveness, you must have made 120 qualifying payments towards qualifying federal direct student loans under a qualifying federal repayment plan while employed full-time for a qualifying organization. You can only request forgiveness once you've met all of the requirements and made your final 120th monthly payment. The program was established on October 1st, 2007. Because 120 monthly payments are required in order for a portion of the loans to be forgiven, our first eligible borrowers won't reach this point until October of 2017. So, we don't know exactly what the forgiveness process will look like. But we do know the requirements for forgiveness. In order to be eligible to have the remaining principal and interest on your qualifying direct loans forgiven, you must have made 120 separate full monthly payments, made those payments under one or more of the Public Service Loan Forgiveness specified repayment plans, have documentation of full-time employment at a qualifying employer while those payments were made, must not be in default while requesting or receiving forgiveness, and must be a full-time employee of a qualifying organization while making the required payments and at the time that you request forgiveness and at the time that forgiveness is granted. Although it will be some time before you can officially request to have the remaining balance forgiven, there are some steps that you can take right now. First, you can make sure that your loans qualify for public service loan forgiveness by reviewing your borrowing history at nslds.ed.gov. You can also contact your loan servicer to make sure that you're enrolled in a qualifying repayment plan, especially pay-as-you-earn, income-based repayment, or income contingent repayment. You can also document any qualifying employment that you've had in the past and start documenting qualifying employment moving forward. Qualifying employment is verified by using an employment certification form. You and your employer will complete this form to verify the time that you have spent working for a qualifying employer. Once the employment certification form is submitted, a review will be conducted to determine if the employer is an approved public service organization. You'll receive notification once approval has been granted. At that point, all eligible loans will be transferred to Fed Loan Servicing. Fed Loan Servicing is the official Department of Education servicer that works with students pursuing public service loan forgiveness. Their representatives are specially trained to help you pursue this opportunity. Once the employer certification form is processed, you'll receive notification of any qualifying payments that you've made in the past with all of your prior servicers. It's possible that you may have already made payments that qualify for public service loan forgiveness. Finally, you'll be reminded annually via email to submit a new employment certification form. Even if you haven't changed jobs in the last year, we encourage you to complete a new form on an annual basis. This makes sure that the number of payments that you have made are accurately tracked and that when you reach your final payment, you have all of your qualifying employment documented. Let's take a look at some other resources that can be helpful for you moving forward. To review your federal financial aid history and to locate contact information for your federal loan servicers, log in at nslds.ed.gov. To review federal student loan repayment plans, learn more about the loan consolidation process, or get an estimate of your monthly payments under different repayment plans, visit the Department of Education at studentaid.ed.gov. To apply for an income-driven repayment plan or loan consolidation, access studentloans.gov. And for more information about the Public Service Loan Forgiveness Program, visit the websites for the Department of Education at studentaid.ed.gov or Fed Loan Servicing at myfedloan.org. You can also contact your federal student loan servicer for additional assistance, or feel free to reach out to our office with any questions or concerns that you might have. You can reach the IUPUI Office of Student Financial Services at finaid@iupui.edu. I want to thank you for taking the time to learn more about federal student loan repayment and loan forgiveness opportunities. Take care and have a great day.